Hello and welcome to our next installment of the Convergent video series. Here we're going to be focusing on a review of the first quarter investment and economic data, as well as our view on kind of what we see coming here over the second quarter of 2023. So thank you for joining us, and I'm excited to take you through the presentation today. So we're going to start with a market review of the first quarter of 2023, which was a pretty marked difference from what we saw through most of 2022. So, first and foremost, the NASDAQ, especially near the end of the quarter, really took off and finished up over 15% on the quarter, with the S&P 500, the broader index, up about 7%. And then we had the Dow Jones and the Russell trailing pretty significantly to those indexes at the start of this quarter. The Dow being a little bit more industrial, did not do quite as well as the tech-heavy NASDAQ, which also has a lot of influence on the S&P 500. In terms of the world markets, we saw emerging markets pretty much match the S&P 500, with the world index up about 7% on the quarter, with emerging markets trailing that just over 3.5% on the quarter. We saw commodities, which had been doing well through higher inflation levels in 2022, have been tailing off as we've seen inflation recede, and also have started to see some challenging economic data. And so when we go into recession, typically commodities, there's lower demand, and so we see some pricing pressure coming in the commodity space. We did see a nice uptick in the price level for gold as inflation, not really as inflation, but the value of the dollar came down a little bit in Q1. And just whenever there's a banking crisis or any sort of major concerns, we typically see a pretty good overall performance of gold. And you see that early in March when the banking crisis kicked off, gold was effectively flat on the year up to that point, and rose pretty significantly since that, and we saw the same output from silver as well. In terms of the bonds, again, a big difference so far in the beginning of 2023 versus 2022. We've seen a big reversal in interest rates that have come down, which has allowed the pricing of much of the bonds to do much better this year so far, with the 20-year Treasury bond up about 7% or so, just under 7% on the year so far, with the shorter end bonds being up slightly on the year. And where we see a big where some of that big return came from is we saw interest rates rising pretty significantly up through the very beginning of March, and then especially 2-year rates and longer. Once the banking crisis kicked off, we saw a significant reversal in those rates, and they're now down closer to 4% versus up near 5% that they were just earlier in the quarter. And we also, along with some of the economic concerns and other commodities falling, we also saw a similar experience with oil, with the price of oil coming down about 9% by the end of the quarter, although now being just a few days into the second quarter of 2023. OPEC just recently announced a over $1 million per day oil cut, which has sent the price of oil skyrocketing pretty significantly here in the last few days since the end of the quarter. So overall, a very positive market outcome in Q1. So a lot of relief in the stock markets, as people's portfolios likely recovered at least a reasonable amount in the first quarter, especially if you were more aggressive and had the impact of a pretty severe drop in the first, or in most of 2022. You saw a little bit of recovery in the first quarter of 2023. What we're going to go through now is an economic review of the first quarter, as well as a lot of economic data that we see coming over the next quarter, which gives us quite a bit of cause for concern. And we said that at the beginning of Q1 as well, where we saw a lot of similar data coming. But I think a lot of people took that weakening economic data as a sign the Fed would likely pivot and no longer be raising interest rates. And so we're still in this phase where it seems to be that bad news has been good news, but I think the Fed was pretty clear in a lot of their comments in the first quarter that inflation is still going to be their number one issue that they're going to be dealing with, and that the likelihood, even through the banking crisis, they reiterated by raising rates in March and reiterating that they're going to keep rates steady through all of 2023. So I believe that as more weakening economic data continues to come out, we could start to see bad news being bad news again, which is overall long term is healthy for the markets and the economy. But we're still seeing some last glimpses of when bad news comes, the markets have been going up with this belief the Fed is ultimately going to have to pivot. So let's dive into a bit of the data. So I'm going to start with kind of the big headlines of Q1, which was the regional banking crisis that we all heard about. And as you see from the first chart there on the left, the largest increase in bank failures since 2008, and so some of the largest ever as well. So we pretty much avoided any bank failures since about 2013, anything significant at least, and so huge spike here in 2023, and a lot of people believe we're not necessarily done with this banking crisis yet. Now, Signature Bank and Silicon Valley Bank, the two banks that failed, at least the biggest banks that failed in March, also had some of the riskiest depositor base, meaning that they had a significant amount of their depositor base having over 250,000 of deposit balance in the bank, which left them very susceptible to higher and higher money market rates. And it created this very quick movement of depositors out of the bank in early March, which then quickly led to the failure of those banks because of the balance sheet imbalances that they had. So is depositor base the only issue with with these banks? The answer, unfortunately, is no. And when you look at the other big concern we have on the horizon with regional banks is commercial real estate loans. And right now, many of the commercial real estate loans are originated in the kind of more regional, smaller banks. And when you look at some of the risks we see coming in that space, there's a significant amount of those loans over the next 2 years that are going to need to be rolling over. So a lot of these commercial real estate loans are maturing, and they're going to have to be refinanced or paid off. And our view is, given the amount, especially in the commercial office space world, which is a pretty significant chunk in the red of that chart on the left, we've seen vacancy rates since COVID dramatically increase and stay really high. And so even though we've had a significant amount of additional commercial real estate in the office space built, we've not seen people moving back into the offices at any meaningful pace since then. And so it creates this huge risk that these owners of commercial real estate with these large loans are not going to be receiving enough in rents to cover the cost of those loans, which could create a significant challenge coming up, the next challenge ahead for regional banks. So, what data out there is giving us some concern that we are going to see some problems. First is GDP. We are expecting that over the next couple of quarters that we're going to continue to see, negative to flat quarter-over-quarter growth in GDP. And so as we see slowing economic growth, it's going to put just more strains on the overall economy. We also do anticipate to continue to see inflation come down, but it is going to remain at a much stickier, higher level than we've experienced in the past. So we are anticipating as we get into Q2 and Q3 of 2023, we're going to see, inflation rates closer to 4%. But again, that's twice as high as the Fed's mandate and twice as high as what we've been experiencing, for most of the years leading up to COVID. And with the recent spike in oil prices and OPEC making their moves to try to prop up the price of oil, we're not likely, at least in the short term, to see any relief from the gas pump as oil prices have spiked back up so far this month. So other concerns that we see out is real earning growth. So in past inflationary cycles, there's been times where earnings growth has also followed significantly with inflation, but what we've seen is really a very long period here, almost 2 years of real earnings growth being negative. So even though earnings are up and people are making more money, it's not keeping up with the pace of inflation. So we're actually seeing people's economic, output, their lifestyle continuing to be constrained and to be squeezed here by inflation. And some other areas that we're starting to see this is the significant rise in credit card balances over the last year or so. and you combine that with a significant increase in the average credit card interest rate, and it makes for, again, a larger amount of total payments coming out from the consumer just to pay off your credit card than we've seen anywhere in the recent past. And then combine that with, while housing has slowed the increase in pricing, it's with interest rates up so much, the affordability of housing is at one of its worst places that we've seen in a very, very long time. So there's not been any, as the economy has slowed, as housing prices have slowed their increase, again, interest rates are up so much that it's not making much of a dent in the affordability of housing. And we're starting to see some constraints and some strain in the labor market. And so we've seen a large number of layoffs slowly and steadily increasing over the last number of months, not only in the small business space, but also in the tech space. And while, many of these people have, because of the amount of job openings that we still have out there, many of these people have been able to find new jobs relatively quickly, and they may not have hit, the unemployment rolls yet. The fact that we are starting to see a pretty significant decrease in the jobs open, along with more and more layoffs, just again puts some data out there that gives us some cause for concern for what is coming. So net, when we look at everything, while the economy has remained steady, so far through Q1, we are starting to see a number of data points that are pointing to, some risks out there, whether it's in the commercial real estate space starting later this year, even in the corporate debt space. They have a similar rollover event that's going to need to come, especially the more junk-based type companies in the Russell 2000, Russell 3000. A lot of their debt is going to need to roll over here late 2023 into 2024. So if we don't see a significant drop in interest rates between commercial credit and corporate public company corporate credit, there's a lot of strain coming in the market at a time when we're seeing worsening economic data and layoffs. So all in all, we definitely feel that there is a cause for concern, and we're positioning, and we have stayed positioned more defensively so far this year, and we anticipate we're going to be staying that way at least for the coming quarter or two. So if you have any questions about that, we'd love to chat with you more. If you have any concerns about the data that we're presenting, please don't hesitate to reach out. For our clients, we've been positioning for this for the last number of months and really throughout 2022, and we anticipate things to remain choppy and volatile. And our view is we can't really predict the future. All this data points to some challenges ahead, but there's a chance that it doesn't come to fruition. Our view is that we just need to be prepared for whatever market environment that we're headed to, and we believe we are prepared for that. So with that, thank you for joining the video today. And again, if you have any questions, please don't hesitate to reach out. We look forward to talking with all of you soon.